we're moving to an FOMC that is more Trump nominee dominated, that is got a heavy hand with those dominant members of being right, of being on the right side of this debate now for a while. And so I think you're going to start to see people fall into line, wonder what the rationale is for staying in this, what looks like much more restrictive stance than maybe they thought they were even as little as a week ago.
And wouldn't it be easy if the Fed only had to concentrate on what's going on in the labour market? But unfortunately, they also have to watch what's happening with price stability. And so on that point, David, we've been hearing this earnings season from so many companies, and just, in the last day, from sort of the staple companies like Colgate-Palmolive and Kimberly-Clark, the likes of which make all the things that everybody needs, soap, toothpaste, tissues, etc. And yet they're also talking about muted demand, and they're also talking about the millions and millions of dollars that the tariffs are going to cost them, and the fact that their input prices are also really biting. How much of a problem is inflation going to be?
So, Mandy, you bring up two good points, and they're a little bit, opposite each other. One is the weakness in demand, and the weakness in demand is, I think, directly coming from that restrictiveness in monetary policy that has been misjudged. And I think we've set out a lot of reasons why over the last couple of years that the Fed was misjudging the overall stance of monetary policy, because they misjudged how important the balance sheet was to the setting of monetary policy. And that big balance sheet was stimulative. And now over the last 2 years, it's gone back to more neutral, meaning that the rate side is far more restrictive without that balance sheet than it was in the past. And I think we're seeing that in the data. So the demand side should be taking the pressure off that price storyline that you were just describing. On the other side, you're going to have this cost push inflation that will attempt to get through. But as I think many folks have argued, this is one-off price level adjustments, not changes in the expectations for persistent inflation. And so I think without the demand side kicking in, this is not inflation that's going to be something that sticks around for very long. And there is a very good chance, Mandy, that a lot of that price increase, a lot of what we're seeing go into the tariff coffers at the Treasury, which is a sizable amount of money, a lot of that does get eaten up, not just by the consumer, but also by the producer. So we're going to wait and see how that works. It could also get knocked around a little bit by currency moves that offset that as well. Mm-hmm. But someone's going to pay, whether it's a third, whether it's 20%, 40%, 40%. We don't know how it's all going to pan out. But there is a story that's probably not great for margins, and it's probably a little bit stickier on the price level side for a short period of time.
Indeed. So why don't we just sort of unpack what's going on with earnings a little further then, and how it pertains to the direction of the market over the remainder of the year, David? Because, yeah, okay, we've had a wobble over the past week, but essentially it's been a really good rally since the April lows. The problem is, I'm wondering whether the E part of the PE equation needs to play a lot of catch up here. Is the market expensive compared to how earnings are tracking?
So we've had some pretty amazing earnings releases, particularly in the tech companies that you pointed out, I believe, that everybody but NVIDIA has reported. And I think out of all the reports, the majority, if not all of them, maybe except for Amazon, beat pretty substantially. So the earnings side actually looks pretty good. And we're seeing, a whole technology story that's embedded in there, and another sort of just set of cost-cutting measures and just advances that are driving that. So I don't worry so much. And kind of where I think you have to make your bet is more on the interest rate side and the multiple side, and whether we're going to get to something like a 25 multiple instead of a 23, 24 multiple. And that's the next ratchet up to get us to the 7,000 level on the S&P toward the end of the year. I think it's more about multiples than some sort of earnings surprise that gets you there. Because earnings are on track to be, I think, pretty strong this year, and they've already come in pretty strong. Maybe that should also surprise us a little, Mandy, because the labor market hasn't been that strong, and large parts of the consumer sector haven't been that strong. So imagine if the Fed lowers rates, we get a little bit of sort of strength in demand to kind of cushion things. We may get a little bounce in earnings as consumers feel a little better, particularly on the housing side and the interest rate sensitive side of things like credit cards.
So what brings the rally to an end then? You know, the market's been able to shrug off the various incoming erratic and unpredictable daily headlines from tariffs. It's now sort of from an economic perspective, latching onto bad news is good news with regards to, you know, what the bad payrolls number could mean for interest rates. You're not particularly concerned about earnings. So is it all happy days from here, or surely there's got to be something on the horizon which could bring it all undone?
Well, Mandy, we've stayed pretty steadfast even through April and those dark days in the first couple of weeks, trying to talk people off ledges and tell them that, you know, this was a tactic for negotiation, not a desire to sort of blow up the global trading arrangement, but just to create fairer trade from the U.S.'s perspective, because the U.S. didn't feel like it was getting the fair shake that it wanted. At least this administration felt that way. And the way to get people to the table is to threaten their livelihoods, especially if you feel like they're getting more out of the arrangement than you. They have more to lose. I think that all played out pretty much as scripted, and now we're getting to the finalities of those deals. But I don't see trade really being the catalyst for something major. I think monetary policy has been sticky and probably is not the catalyst for something dangerous, or fiscal policy or regulatory policy. I think all of those policies are kind of going along the Trump trajectory as many would have thought. So really, when you're looking for something to go against the grain, you're probably looking at geopolitics. You're looking at something with Russia, Ukraine, with Gaza and Israel, with something in Taiwan and China. Those are the places where things get sticky, negative supply shocks driving commodity prices higher, and there's a temporary nervousness about inflation. The Fed has to pause, and we get a little bit skittish on risk assets before we figure out what the end game is in that shock. So there's always those. They're very difficult to predict. But on the policy front, I really think where we're sitting now is a pretty amazing place. And I think that if monetary policy's trajectory is as I think it will be, and we're going to ratchet this thing back to more rate cuts toward a two-handle Fed funds rate expected, 2.5, something like that, then we've got a lot more to run in fixed income. We're going to take 10s below 4%. We're reinvigorate the housing market. And I think we're going to have a pretty good run into the end of this year.